So obviously, looking forward, some countries are expected to grow faster. This is 10% or more. There's not a lot of that. There's a little bit of 6 to 10. You know, we're in this 0 to 3% range. So we saw 4.2 in the first quarter. We saw 3 point something. We saw 2 point. We saw a slow, steady decline this year. So we had the sugar high. We got the tax breaks. We had a huge pop up in growth. There's a lot of arguments that say we cannot actually grow more than 2% without borrowing from the future. And the reason is we don't have enough immigration. We don't have enough productivity growth. If we don't have productivity growth and we don't have more people, then we can't get more done. It's pretty simple. So 1.92% is our cap. Anything above that is borrowing from the future, or it's excavating from the past that we were below the line, right? So right now we're not below the line anymore. Now if we do something and stimulate ourselves with tax breaks or fiscal spending, we're going to be borrowing from the future. We can expect our growth to be 2% or less for the foreseeable future. There's nothing wrong with that. So the slowdown is expected. The slowdown is something we knew was coming. It has to come. If it doesn't come, then we're pushing the runner too hard, and the runner's going to have a heart attack. So we have, for the last 5 or 6 years, built that international piece, right? So this is from April of this year till the end of this year. Notice before then, lockstep, international and US right together. April of this year till the end of this year, of 2018, this is S&P. This is not the S&P. This is outside the United States. So this differential is pretty big. What is that? 20%? 18%? So those of us who had, which is all of us, anyone that we manage money for, had a large exposure to the international. So you got that statement at the end of December, and you said, Jonathan, why did we do worse than the S&P? We're not just in the S&P. We have the S&P, we have a lot of international markets, we are diversified. And that diversification, it looks like it hurt us, but diversification worked. It did what it was supposed to do. Like we weren't supposed to, the S&P is not our target. Yes?
This chart ends in October?
Yeah.
So.
Yeah, it got worse at the end of the year. Yeah. So far this year it's actually reversed. And in 17 it was reversed. But longer term, the expectation is that A, there's value in buying dollars of earnings cheaper, and we'll talk more about this in philosophy. And there's also expectation that those economies that grow more quickly will actually be beneficial, right? Because that affects the value of the dollar. There's all kinds of reasons that the US did better last year. Okay. So our argument for some time has been that when market imbalances grow this extreme, they don't persist as a rule. Now that we've begun to see major falls in tech and the tech-heavy MSCI China index, the question is how the rebalancing is likely to play out. After the bust of 2000 and 2008, beaten down sectors recovered. Small, medium caps came back to life and forgotten countries were rediscovered. So we saw in the dot-com world, we saw a subset of the economy do incredibly well. 2008, we saw a different subset. 2006-07, we saw a different subset of the economy do really well. What is the word given to the subset of the economy that did really well for the last 3, 4, 5 years? What's the word? You guys can, you know it? FANG. There's 5 stocks. Right? That has driven the S&P. They are like, 30% of the S&P. Those 5 stocks. So we have a concentration that has done really incredibly well. But I would be very wary of being in a portfolio that concentrated because this happens. The minute things take a turn, and this time they took a turn and they bounce back. Next time they take a turn, they might bounce back. There's going to be a time when they don't bounce back. When Facebook is actually separated into different parts, told they can't sell our data, and then Facebook goes to 0 or much smaller than it is now. There's a time when Google is not allowed to do what they do. Right? And I don't think that time is far away. It doesn't matter. I'm going to stay very broadly diversified anyways. I'm never going to be concentrated in one thing, which means when those 5 things do really, really well, we're going to lag, right? That's a safety. At the same time, Value. So this here is 2016 to 18, that red line, that's value lagging. So think of those 5 stocks. What are those stocks? Growth stocks. So growth has been in favor, not just for the last 3 years. Growth has been in favor since probably 2008, 2009. Growth has come out of the gates and gone gangbusters. That does not last forever, okay? We stay diversified, and actually our bias is value. And we'll talk about why at the end in philosophy, okay? At the same time, so this is listed companies. See this decline? This is 2006, 9, 10, 11. That's 8, 7, 8, 9, 10. So this is 2007. See this decline? That's the number of companies that are publicly traded. So some companies go under, some companies are swallowed up by other companies. So this creates a concentration of the number of stocks we can buy, which further pushes up those indices that get driven by, everyone just pumps money into their Vanguard index, and that goes straight to those FANG stocks because they're 30% of the index. So if you're somebody just without thought buying the index, you're going to end up owning and being very concentrated in those pieces. Okay, and here's where a lot of the volatility comes from. This is 2004, 2017. The blue is, retail investors and mutual funds buying and selling stocks. Notice it hasn't really changed. That volume hasn't changed. This is trading volume. This, 2004 was the first year we had sort of a subcategory of high frequency trading. So that's red. That's quant. This is the programmatic stuff. When the stock market goes down 6%, we sell a bunch of stuff. No one decides. It just says the market goes down 6%, we sell a bunch. What this does is this exaggerates every move in every direction. Does it change the value of the companies we invest in? Not at all. It doesn't change the value. The fundamental value is driven by the earnings that a company produces. It doesn't affect the earnings that a company produces. Right? So we're going to see more volatility. That's not going away. That is here to stay. And it'll probably increase unless we see a per share cost on trading, which is possible. We might see that. Investors will soon, well, this is obviously written in late 2018, soon bid good riddance to 2018, a stressful year marked by 2 stock market corrections, rising interest rates, an ugly trade battle, growing fears that a bear market lies just around the corner. Next year is looking rather sunny. So say the 10 market strategists Barron's consulted this month. And look at that. We talked about this earlier, 14%. To get back to average, we get that. To get back to average valuations, we get a 14, 15% this year on the S&P. And there's not really a sign that there's going to be a recession. So this is interesting, right? We talked about the FANG stocks, but this is, even though the S&P overall is not in a bear market, does everyone know what a bear market is, technically? 20% peak to trough closing decline. So we stop at 100% and we go down to 80% or less. That's technically a bear market. Last year we got close twice. We got close in February, we got really 19.8%. In fact, if you looked at intraday, the way the stock market moves intraday, we actually hit 20%. But we never closed 20% down, so we're technically not in a bear market. That's what she's talking about. But internally, a whole bunch of stocks were. Half of the S&P is in a bear market, half of it's not. Okay? So there's a lot of action internally. In fact, we've probably seen, I just read a statistic, we've probably seen 5 internal bear markets since 2008. So we look at the big picture as something that just keeps going up and up and up and up, and we say, look how long this lasts, it can't last forever. We don't see what happens internally. And there's been 4 or 5 internally bear markets since 2008. We talked about this a little bit. We expect global growth to slow next year. See the US is stabilizing at a higher level than other regions, even as the effects of 2018's fiscal stimulus fade. He's a little bit more optimistic, or they're a little bit more optimistic. I think we have to come back down to that 2%. They're saying it can stabilize a little bit higher. But the US, risk of recession in the US is low in 2019. And everyone I talk to says that. And this is what we always remind you of. Everyone hates diversification in a bull market, but it pays when those mainstream FANG stocks hit the bear. Makes sense.